Fantastic. Having a good day? Learned a lot? Met some new people? Hand up, hand down? Wonderful. Good. Who likes money? Good. We're talking about money now. Lots of money. Okay, so this is the finance section. Going to keep it fairly fast-paced. So, are you or will you be fundraising for your business in the next 12 months? If you'd just like to answer that question on the Slido system. Well, if it stays like that, this is going to be a pretty boring session for you. Good. We have a few. Not yet. Maybe. Oh, there we go. It's neck and neck. Yes, but okay. Wonderful, wonderful, wonderful. Okay, so not yet, but maybe in the future, 36%. You were probably feeling sorry for me watching that graph in the beginning. Yes, 30%, no, 22%, and yes, but not sure how to go about it. Okay, so this section is about two main things. One is how you fund your business growth and different options to do that. And then the other one is if you want to sell your business, different valuation methodologies and what actually drives business value. Okay, so I am aware that there in the audience today we have some absolute experts, people that run funds, and this is going to be teaching you to suck eggs, so I apologize for that in advance. And then some people, it's going to be really insightful, hopefully. We have a principle in Bolt that about simplicity. So our strap line is simply good business. Okay, and I think simplicity is really important. And what we mean by that is try and explain things in a way that a 14-year-old of average intelligence would be able to understand. Okay, because there's going to be some of you that see a spreadsheet and your eyes will glaze over and you just don't like numbers, and then there's others that will just like, give me more spreadsheets, all right? So I'm going to try and strike the right balance between those things. Okay, so I'll give you a quick overview to Bolt Angels. Growth drivers, what actually drives growth in both a hard and soft metric factors in a business. Two different valuation methodologies. I'm going to share with you a tool that is going to come with a public health warning. All right, it's a valuation tool for your business. It's an online platform. Okay, it can be amazing to help you raise money. It can be also incredibly dangerous if used in the wrong way. Okay, because it can spit out some very big numbers and you can get a bit carried away with yourself. All right, so I'll share that with you. Some funding case studies. We've got a few case studies. We've also got two innovative forms of finance from two of our sponsors, Wayflyer and Juni. So we're going to have a panel with those guys. And then we're going to talk about the creator, influencer, celebrity economy and a brand that was largely born out of a creator, a very successful creator. And they're going to tell you their story as well. Okay, so Bolt Angels, investors that are the difference that makes the difference. How do we do what we do? And what kind of brands do we invest into? So Chamberlain Coffee was a creator-led business with Emma Chamberlain that did 7 million in its first year of funding. She's one of the top 25 most influential sort of YouTubers and social media influencers in the States. Triple Whale is a data analytics platform. If you've not checked it out, have a look at it. It's amazing for online brands. It brings together all of the metrics from Facebook, from Google, from TikTok, Shopify, Amazon, all of those kind of platforms, and can integrate with your finance system, your bank accounts, to give you a dashboard to run your own business. All right, and we invested in that pre-seed. We were one of the beta tester users of it on a valuation of 5 million, and then it was revalued at 171 million. They're just about to do their Series B round. Is David in the room? No, for a lot more. I'm not allowed to say how much, but they're just about to do a Series B. So if you get it right from an investment point of view, in the right businesses, the right time, the right stage, you can make a lot of money. You can also lose all of your money. So it can be a high risk, a high risk investment strategy. Okay, which is why there's a scheme called EIS, Enterprise Initiative Scheme, which makes it very attractive for high net worth individuals to be able to invest in companies. If the business fails, you can write off a lot of your loss against tax. if the business just breaks even and you get your money back, you're typically 30% better off anyway from an income tax saving point of view. So there's a lot of tax schemes that the government have put in place to make it very attractive for people, for investors to back people like you and fund their business. All right, so check out EIS if you don't know too much about it. And then Jack, we're going to do a live D2C den, Dragon's Den type thing this afternoon. Danny's going to come in and I'm going to explain about a mental health technology platform that we're currently investing into. Okay? All right, so two main ways, two simple ways of valuing a business. The most common one on the left and the safest one on the left, profit times the multiple, okay, equals the value of your company. All right, and I'm going to show you one of the leading indexes that you can access free of charge from BDO Stoy Hayward, a firm of accountants where they track the transactions in the small, medium sector to work out what is the multiple valuation. Okay, and if you don't understand the multiple, the more things you have in place for your business, where it's not reliant on you to run the company, and it's a proper business with staff, that if you weren't there, the business would still keep running and keep going. Okay, the more things you have, if it's scalable, if it's international, if you've got lots of sales, lots of customers, all of these things also drive up the multiple value. So an owner-operator type business might sell on a 1x multiple of profit. Okay, so if you're making £100,000 a year profit and there's no infrastructure, there's no team, that kind of thing, you might get a 1x multiple. Right, you might as well just run the business for 12 months and you'd make the same level of profit that somebody would give you for buying it. Some businesses, technology businesses, can be 20, 30, 40, 50 times multiple of profit. Or, on the other side, more risky, is a multiple of revenue. Okay, so you can have loss-making companies that are in the heady days of kind of D2C, growth. Then you were sometimes getting 5 to 7 times revenue multiples. So if a business was doing £1 million a year in sales, it might be valued at £5 million. Okay, so different valuation methodologies. I would caution you against the one on the right, because you'll always be able to sell a business that makes a profit. All right, and in this market where funding is being constrained massively all the time, and I think will continue to be, what you're hearing from a lot of VCs, a lot of funders, a lot of angels is, when's the path to profitability? How soon are you going to be profitable? All right, you'll always sell a business, or can sell a business with a multiple of profit. You can also live off the profit, all right? Whereas the other one on that side, if you continue to be loss-making, it gets more and more risky, okay? So that is the dangerous tool that I told you about. It's about £250 to kind of use it. And the way that it works, it's an online platform. It spits out 5 different valuation methodologies. One is based on the data that you put in, a 3-year financial forecast or a 5-year financial forecast. Okay, it's called Equidam. And then the other side of it is a big questionnaire that you fill in, which is the qualitative side of it. How long have the founders been in business? How many of them are there? Have they ever sold a business before? How much industry knowledge do they have? Right? And it uses all these kind of complicated algorithms based on Silicon Valley methodologies for valuing companies. All right, and you can play around with the measures and all of this sort of stuff. All right, but as I say, be careful. I've seen some people use it. You know, they've got an idea, they've got a team, they've got a bit of a track record, and all of a sudden their business is worth £14 million. Okay, so just use it with caution, but it's a great way of getting an indicative value of your company. So I haven't got time to go through all of these, but just, I've shown you the simple method. This is a more complex method, and this is where business really becomes more sophisticated. Intelligence, one definition of intelligence is the ability to make finer and finer and finer distinctions. All right, so the more you understand something, the more you drill down into the detail. And if you want to know what's really going to drive value in your business, from a hard metrics point of view, they're the things to focus on. Okay, customer acquisition cost, the average order value, the customer lifetime value, your gross margin. In a direct-to-consumer business, if you've got a delivered gross margin of less than 40%, that's a little bit of a warning sign. When you see some brands that have got a delivered gross margin of 60, 70, 80, even 90%, amazing. You know, if you've got an average order value that's quite high, customer lifetime value, they love your product, they're coming back time and time again. You know, Absolute Collagen, one of the reasons that was so successful as a brand and was sold for 43 million was because the product lasted 2 weeks, right? The utilization rate. So understanding what the utilization rate is of your product and seeing if you can increase that is really, really important. The average order value, that was a really sticky product. People, once they started using it, would lose the benefit of looking younger and healthier and having their hair grow if they stopped using it. So the lifetime value just ticked up and up and up and up. And the cost of acquisition back in the day was around about £25. Okay, so they were profitable on first purchase, and then people just kept coming back and back. So it was just a kind of a cash flowing machine type of business. Okay, and there's an old saying in business, strategy trumps tactics. Okay, so strategy trumps tactics. In this kind of model, it can be really hard if you've got a brand with poor unit economics to change the model, right? So a guy came to us about 2 years ago and he was selling tea, you know, little bags of tea for about £5. Only direct to consumer. His cost of acquisition was between £20 and £30. And he was like, he'd remortgaged his house, gone all in on this brand, passionate about tea. And we looked at it and it's like, okay, your average order value is £5. It's costing you £25 to acquire a customer. Your tea bags are going to last quite a long time. I think it was about 60 in a box, all right? And the utilization rate was low and the average and the lifetime value was low. So you can just see it on a spreadsheet. The guy was going to be in trouble. So we then recommended bulk buy, you know, do 5 at once and try and get the average order value up. You know, try and maybe put less in the box to increase the utilization rate. All right, so there's all these levers that you can pull, but if you've got a business with poor economics, then it can be, you know, a hard thing to unwind. And I'll show you a little spreadsheet, and you can have it to play with at home if you want to, which is a simple analyzer where you can plug in your unit economics and see what that spits out. And it's kind of color-coded red, amber, green. And if it comes up red, you've got a problem, and you need to fix some of the business levers that you've got. And then you've got the soft stuff, which is also critically important, brand, you know, the brand value. That's quite a hard thing to actually, you know, kind of analyze. The quality of the team. We talked a lot today about the people, the quality of the people, these things. The quality of your supply chain. Have you got one supplier? Are you at risk if something happens to them? Have you got multiple options? Do you have supply in-house? So the manufacturing, have you brought that in-house? That can be a massive enhancer. And you'll hear a case study a bit later where somebody's done that with their brand. Okay, community. Have you got an online community? A very famous brand called Huel, you know, was built on the success of people absolutely fanatical about nutrition and saving money and giving all their nutrients, and they called them Hueligans, right? These Hueligans were basically spread the word of this brand, and it did hundreds of millions worth billions of pounds because it was built on that community. Really, really important. DTC. But also multiple channels, not just being online, you know, maybe starting online, but going into stores, right? Retail, wholesale. We've got a dog supplement brand called Buddy and Lola. We've just been picked up by Pets at Home, all right? Game changer for the brand and the business and the scale because we now retail as well as direct to consumer. So this is basically an index that you can access. It's not the only one, but it's a very good one. Okay, and the key one too. This is the kind of FTSE market, and then you can see private company index is about a 10 times multiple. Okay, so what that basically means is if you're making £100,000 or £1 million a year profit, the average sales in the last quarter, you can see how they go on a quarterly basis. It's been fairly consistent actually for about the last 3 years, around about a 10 times multiple. So 10 times your profit will give you the value of the company based on this index, which is normally about 500 or 600 companies are analyzed each quarter. Okay, but massively subjective because of all of these things. If you don't have many of those or they're not very good and they're pretty weak, then you can, you know, this means nothing. This is for more established professional companies that have got a lot of those things right. In terms of going back to this one, the revenue method, okay, we've seen in tech anything between 10 and 40 times revenue. okay, can be quite common in the kind of the tech sector, in the direct-to-consumer sector. Before COVID, during COVID, you were looking at a kind of a 3 to 5 times was quite a common revenue multiple. Now it can be down at 1, 2, even less than that as well. Okay, so what tends to happen when markets constrict is the multiple from a revenue point of view drops through the floor. Okay, because people are focused on profit. Okay, and then this, I'm not going to talk it through, but this is just who's the lady I saw earlier this morning that got this a while ago? Is she here? No, somebody came up to me and basically said, thanks so much for sharing this with me. I now use this as an analysis tool with all of my customers. When somebody, she runs a marketing agency, when somebody comes to me and they want advice, I ask them, do you know the answers to this? If they don't, then I help them find the answers to that. And once we've got the answers, anything that comes out red like that means they've got a business that is probably destined to fail unless they take some fairly radical action with some of these unit economics up here. Okay, so you can have a copy of that. Just send us an email or let one of the team know. We'll give you a copy of that and you can apply it to your own business. Does everyone know how to analyze the lifetime value of your customers? Does anybody not know that? Okay, good. A few don't. Right. Probably a lot more that weren't willing to put their hands up. There's a great, if you're on Shopify, there's a great platform called Lifetimely, or a plugin called Lifetimely. If you plug Lifetimely into Shopify, that will look at your lifetime value, 3 months, 6 months, 12 months. You can scenario plan what the future might look like based on the historical metrics. That can be quite a hard one for people to understand. Okay. Great, and then the last one, and then we'll get the, Tash will come up and we'll do the next interview. This is really the kind of the typical funding journey from a profit point of view and the 4 main stages of business growth. This is the profit line, okay? So typically, in these first 2 stages, a brand won't be profitable. When it reaches a certain critical mass, it can then be profitable and then going down towards exit and being a viable business to sell. And the types of finance that are available, somebody said earlier, how do you start your business? On credit cards. You know, credit cards, loans, the 3 Fs, friends, family, and fools. The most common types of investors in early stage businesses, okay? Angel investors, sometimes venture capital, but not typically. A lot of venture capital typically starts around 5 million. If you talk to like the British Growth Fund, for example, they'll want to typically see 5 million in revenue, as well as a lot of those other things from those hexagon diagrams in place. We typically invest sub 5 million. All right, so we work with more early stage businesses. Bolt Angels, we're an angel investor. And we're looking for real potential, massive scale businesses we're passionate about that we can really make a difference to. All right, so there are angel investor communities here. Loans, some of the finance we're going to talk about later with Wayflyer and Junie is amazing. It's a real innovation over the last couple of years. Unsecured loans at very good interest rates, credit cards to finance, Facebook advertising, unsecured, so you're not putting your house on the line or other security on the line. There's a load of innovative funding options now. Crowdfunding, obviously a big one. Crowdfunding's also evolved in the last couple of about 18 months with secondary markets. So seeders, for example, will allow people to invest in your company, and then once a month, I think it's for about a week, they open up shares in your company to a secondary market, which means people that have bought a share at a certain price, that they can list them if they want to, and it's like an auction, and another investor can come in a bit later and actually buy shares from you, so you can exit earlier. So secondaries are becoming more common now. Okay, so you can understand or you can appreciate where you are, and then obviously it doesn't always go up like that. With my business in 2001, it failed, and that is the harsh reality. Is depending on the statistics you look at, about 7 out of 10 businesses will fail in the first 2 years, and about another 90% of those will fail in the next 5 years. So running a business, being successful is not easy. That's why we run events like this. That's why we do training. That's why we want to share our knowledge and expertise to stop you guys avoiding the kind of mistakes that we've made in scaling our business, because it's not easy, especially as we go into a recession. Sorry to be a doom mongerer, but I have a philosophy. that I like to impart and share with people, which is hope for the best, but plan for the worst. You know, I hope I'm wrong with my economic predictions as to what's coming, because I do believe it's going to be bad. So just prepare for it, right? But if it's not and I'm wrong, fantastic. All right, hope for the best, plan for the worst. Wonderful. Okay,